So I'm going to ask you a question now, okay? Here's a test to see whether you really understand this concept. I want you to think about a biotech company that has developed a compound for a really nasty form of cancer, let's say glioblastoma. And they just passed through phase 1, and they're now starting phase 2 trials where they've already deduced that the particular compound is relatively safe. There are some side effects, but not bad. And they're now getting to a larger sample of 50 to 100 patients in phase 2. And that trial is going to last 3 to 5 years, depending on how quickly they can recruit patients. If you're an investor investing in a phase 2 trial, are you facing systematic risk or idiosyncratic risk? What do you think? If you had to put a beta on this effort, on this project, on this company, you think it's got a high beta or a low beta? Are we talking about systematic risk here or idiosyncratic risk? What kind of risk? It should be idiosyncratic risk. And the reason is because whether you succeed or fail in your glioblastoma drug should have no bearing on whether the stock market is up or down, right? No bearing. Because you're talking about scientific risk, not financing risk, scientific risk. There's no financial exposure to whether or not your trial succeeds or fails. And you all agree with me, I think, that if you succeed, you will make tons of money. Because right now, there does not exist any effective therapies for glioblastoma. And so if you can come up with the first effective drug, even you pass through phase 2, you actually will see your value skyrocket. And so that up or down should have nothing to do with the stock market, right? So I have an interesting point to make, which is that if you take a look at biotech companies and you look at their betas, and this gets back to Yuki's second point, biotech betas are huge. They're really big, much bigger than pharma betas. In fact, I'm going to show you in a few minutes how big they are. And I'm going to ask you to tell me why. So let me skip this slide. I'll come back to it next time because I want to make sure that we cover this one empirical fact. These are the capital asset pricing model estimates of the betas of successful pharma companies on the left and smaller biotech companies on the right. They're all publicly traded, so I have data from the stock market to be able to run a regression and estimate the betas. And we'll be giving you the Excel spreadsheet so you can do this on your own. And you'll notice something really interesting about these beta estimates. The beta estimates of the pharma companies are quite a bit lower. In the case of Eli Lilly, it's got a beta of 0.24. So that certainly looks a lot like Yuki's point about scientific risk should have very little correlation with the stock market. Gilead, on the other hand, the maker of the Sovaldi and Harvoni hepatitis C drugs, they've got a beta of about 1. GSK, 1. Johnson & Johnson, 0.64, and so on. The traditional pharma companies have average betas that are less than 1. Now let's look at biotech. So Agios, a beta of 2.3. Alexion, a beta of 1.39. Alnylam, a company founded by our very own Phil Sharp here in town, just a few blocks away, 3.16, a beta of 3 times the market. So if I plug these numbers into the cost of capital, what am I going to get? Well, the numbers are there for you to take a look at. The cost of capital for Alnylam is 22%. 22% according to the CAPM. And that doesn't take into account all of the other factors that modern financial economics suggests ought to be there in addition to the stock market. There are multi-factor models that will add risk premia on top of that 22%. So this is a puzzle. This is the beginning of this narrative on the Valley of Death. You understand now where the Valley of Death comes from. Pharma companies have a far lower cost of capital than biotech companies, and it just doesn't make sense. Why is that the case? And it gets back to Yuki's point that the risk as a biotech company is not just scientific, because the way that biotech companies are financed has all sorts of strings attached. And if that string gets pulled at exactly the wrong time, you're looking at massive failure. And so financing can often drive the scientific agenda for this reason. You're looking at it right here. A beta of 3 tells you that as a scientist entrepreneur developing new therapies for patients, you've got to keep 1.5 eyeballs on the stock market and half an eyeball on the science, because the plug can get pulled. And the way that you see the plug getting pulled is this kind of a beta risk. Biotech companies are facing these kinds of financing risks. If you're large, successful, you've got a whole family of drugs, they're generating tons of cash, you're not going to face the same kind of financing risks. So there, the betas are less than 1. Okay, so here's just some interesting illustrations of betas. So this is a plot of the returns of Editas. And you can actually see some very, very interesting correlations between that and the stock market. So first of all, the beta of Editas is 1.6, not surprisingly. And by the way, sorry, VOO, I should define it. That's the mutual fund of the S&P 500 offered by Vanguard. I wanted something that was traded, that was the stock market, and that was a convenient method because it also includes dividends that get paid out during this period. So we only have data for about a year, from 2016 to the present, because that's how long Editas was trading. And for those of you who don't know, Editas is the gene editing company using this new technology called CRISPR. CRISPR had a very big week a couple of weeks ago. Anybody know what happened then? Yeah, John?
A federal court of appeals ruled in favor of MIT and Harvard and granted them a patent over UC Berkeley.
Right. So it turns out that UC Berkeley filed a patent first. But the patent they filed was for the CRISPR technology as it was applied, which was not to humans. MIT and Harvard, particularly the Broad Institute and scientist Feng Zhang, applied for a patent afterwards that took these ideas and applied them into humans. And on that day, Editas's return went up by 28.8%, one-day return. So you can see that finance actually has a pretty big impact on what's going on. And most likely, it's going to continue to have an impact as we see further rulings of various appeals and challenges. So if you take a look at another example, which is Chimerix, here is the cumulative rate of return, the stock price for the company, but something happened here in December of 2015. The stock price dropped dramatically, and what happened on that day was that its phase 3 trial failed. And in one day, a huge amount of shareholder value was destroyed. These companies are facing tremendous financial risks. They're scientific risks, but because the financing affects their viability as a separate company, they actually have to think about these kinds of issues, take them into account, and their cost of capital is much higher because of that. Because at some point, they may get the plug pulled from them, and it'll generally happen when markets are down, not when they're up. So this is some statistical estimates that one of my PhD students, now assistant professor at the University of Minnesota, Richard Thacker, and I developed. We calculated a rolling window estimate of pharma and biotech betas using the CAPM from 1930 to 2015. Obviously, the biotech industry didn't exist really before the 1970s. So you can see that pharma had generally relatively low betas, but there were periods where pharma was challenged and it faced high betas. Right now, pharma is still, on average, slightly higher than a beta of 1. I showed you some big successes where the risks were lower, but not all pharma companies are in the same position as Eli Lilly. So on the other hand, if you take a look at biotech betas, they are almost uniformly higher than the pharma betas. So this tells us that there may be an opportunity here to change the way that we finance these companies to address some of these challenges.